Welcome back to the deep dive. Today we are looking at the pulse of the global economy. But we're not looking at GDP or inflation reports. We are looking at the plumbing. We are looking at Texas Instruments.
The silicon heartbeat of the industrial world. A great way to put it.
That's the one. So TI just dropped their Q4 2025 earnings on January 27th. And if you just, glanced at the headlines, you might have just shrugged. They missed consensus estimates on both revenue and earnings. So technically a disappointment.
And yet the stock just ripped higher in after-hours trading. Up, what, about 8%?
Exactly, which is precisely why we need to unpack this. Because when the market cheers for a miss, it usually means the real story is somewhere else.
The thesis has changed. The forward-looking signal is drowning out the backward-looking noise.
Yes. So we've gone through the whole package, the 10K, the earnings call transcript with the CEO, Haviv Lan, and CFO Rafael Lizardi, and all the presentations. And there is a massive structural shift happening that I think a lot of people are missing.
It really is the difference between looking at yesterday's weather and the forecast for tomorrow. The Q4 numbers, they were kind of damp, a little sluggish.
Yeah.
But the guidance and the strategy, that looks completely different.
Okay, let's start with that miss itself, just to clear the air. Q4 revenue came in at $4.42 billion, and earnings per share at $1.27.
Right, and Wall Street wanted just a penny more on that EPS, just a penny.
But I was looking through the financials, and I saw this little note about a non-cash goodwill impairment, about 6 cents a share.
Yeah, in their other segment. It's essentially an accounting cleanup. It has zero to do with their actual operations, their ability to make and sell chips. It's just a paper write-down.
So if you back that out, they didn't miss. They actually beat by a nickel.
And investors saw right through that. They completely ignored the headline.
But the bigger story, and I think the real reason for that 8% pop, was the guidance for Q1 2026.
This was the surprise. They guided revenue to a midpoint of $4.5 billion.
And we really have to explain why that's a big deal. For anyone who doesn't follow the semi-cycle religiously, Q1 it's the hangover quarter.
August is.
The holidays are over, factories slow down. Usually Q1 revenue drops from Q4.
Right. A typical sequential decline for TI is somewhere in the mid-single digits, maybe more. But this guidance, it's effectively flat to slightly up.
It's defying gravity. It's a complete divergence from normal seasonality.
And when a bellwether like TI, their chips are inside everything from a washing machine to an EV. When they say we aren't seeing the usual seasonal slump, that is a huge macroeconomic flare.
It's signaling that the inventory destocking, this thing that has plagued the industry for, almost 2 years now?
It's finally actually over. The CEO even mentioned that bookings were improving throughout the quarter.
Yeah.
Not just stabilizing, improving.
Okay, but let's be careful here. He was also pretty blunt about the macro picture. He called this one of the slowest, if not the slowest, recovery ever in our history.
Which is a really sobering reality check. We've all been waiting for this V-shaped recovery in industrial manufacturing.
We didn't get it.
We got an L shape that's just barely starting to curl upward. The industrial sector, for example, it grew 18% year over year in Q4. Sounds amazing, right?
Right.
Until you realize it's still 25% below its peak back in 2022.
So we are climbing out of a very deep hole, but the way TI is climbing out has changed, and this is the part of the report that I think matters the most for the long term.
Yeah.
They've completely reorganized how they talk about their business. They are now pushing what I'm calling the big three.
Industrial, automotive, and data center.
This is their pivot to secular growth. And maybe we should define that, the difference between secular and cyclical.
Yeah, it's a good point. So cyclical growth is more people bought cars this year. The whole market grows. Secular growth is there's now $500 worth of silicon in every car when 5 years ago there was only $100.
Right, so it doesn't matter as much how many cars are sold. You're betting on the content inside each car going up.
Exactly. They're betting on content expansion, not just unit volume. And the mix shift is, it's aggressive. In 2013, those three sectors were 43% of their revenue.
And in 2025?
They just hit 75%.
That is a fundamental identity change for a company this size. They're basically shedding the volatility of personal electronics.
Oh, yeah. That segment was down in the upper teens this quarter. The consumer gadget market is, it's saturated, it's fickle. The margins are just brutal.
So TI is basically saying, you guys can fight over the smartphones. We're going to run the factories, the grid, and the cars.
And the data centers.
Okay, let's drill down on that because data center is the buzzword of the decade. But we're usually talking about NVIDIA and some the big GPU guys.
Not Texas Instruments?
Not usually. But their data center revenue was up 70% year over year, 70.
That's hypergrowth. For a company that people think of as a boring analog chip maker, that is an incredible number.
And it's not a fluke, right? It's been growing for 7 straight quarters. It's almost 10% of their total revenue now. But here's the skeptical question I always hear. TI doesn't make GPUs. So what exactly are they selling into these AI server racks?
They're selling the physics, the stuff that makes the GPUs possible. It's all about power delivery and thermal management.
The V-core power sockets.
Precisely. You think about an H100 or a Blackwell GPU from NVIDIA, these things draw insane amounts of power. Upwards of 700, maybe 1,000 watts. You can't just feed that kind of power cleanly from a wall socket. You need massive voltage step-down capabilities sitting right next to the processor. If that voltage so much as ripples, your $30,000 GPU either crashes or it melts.
So TI is providing the regulatory infrastructure on the motherboard itself.
And this is where their real technical mode is. They're making these chips using their BCD process technology.
Okay, let's decode that alphabet soup. BCD, why does that matter?
It stands for bipolar CMS DMS. It lets you put 3 different types of transistor tech on a single piece of silicon. A bipolar for the precise analog stuff, CMOS for the digital logic, and DMOS for handling really high power and high voltage.
And getting those all to work together on one chip is hard.
Incredibly difficult. And TI has mastered doing this on their big 300-millimeter fabs.
And that 300-millimeter part is the economic moat, isn't it? Most of their analog competitors are still on older, smaller 200-millimeter wafers.
Exactly. A 300-millimeter wafer has more than double the surface area. So TI gets more than twice as many chips per batch for roughly the same cost. Their unit cost is just structurally lower than everybody else's.
So while everyone is fighting a war for the brain of the AI server, TI is just quietly winning the war for the heart. The power delivery system.
It's the classic pick and shovel play. Except in this case, the shovel is extremely high-tech, and it has a gross margin north of 60%.
Speaking of spending, we have to talk about the elephant in the room. Or, the elephant in the fab, I guess.
The CapEx.
Yes, the capital expenditure. For the last few years, investors have been groaning about it. It's been dragging down their free cash flow.
It's been painful to watch. They've been building these massive new fabs in Sherman, Texas, and Lehigh, Utah at the same time. That's billions of dollars in concrete and steel that makes zero revenue until you turn the machines on.
But the CFO, Rafael Lizardi, he gave us the signal we've been waiting for. He said they are nearing the end of this elevated cycle.
Finally.
They guided 2026 CapEx down to a range of $2 to $3 billion. That's a huge drop-off.
We are officially moving from the investment phase to the harvesting phase. The capacity is built. And now, the government checks are clearing.
The CPS Act.
Well, the investment tax credit, the ITC, kicked up to 35% on January 1st of this year, 2026.
And I want to make sure the listener really gets the scale of that. This isn't a deduction, it's a credit.
It's a direct offset. For every dollar TI spends on a new piece of qualifying equipment, the U.S. government effectively hands them 35 cents back.
So $1 billion fab line means $350 million back in your pocket. It just fundamentally changes the math on that investment.
It does. And you're already seeing the impact on the cash flow. Free cash flow for 2025 was $2.9 billion. That is up 96% from 2024.
They basically doubled their cash generation in a year where the industrial economy was still, sluggish.
That's the leverage of their model. And remember, as CapEx falls further this year, that free cash flow number really only has one way to go, up.
Assuming revenue holds. Which brings us to the big risk factor, inventory. TI is sitting on a mountain of chips. $4.8 billion worth of inventory. That is 222 days of supply just sitting on the shelves.
Historically, an analyst would see that number and just scream, sell! In the digital world, like for memory chips or CPUs, inventory is like fish. It rots. A 6-month-old CPU is obsolete.
But TI's argument is that their analog chips are more like, fine wine, or at least canned goods. They don't spoil.
That's the argument. A power management chip for a robotic arm or a car window motor, those designs don't change every year. They stick around for a decade, so they're comfortable holding that stock.
Okay, devil's advocate here, though. Holding nearly $5 billion of inventory isn't free. You have carrying costs, storage. Did they just misread the slow recovery and overproduce?
It's probably a bit of both, but I think it's mostly strategic. They call it their turns business. In this kind of jagged recovery, customers don't plan very well.
Right.
They realize at the last minute, oh, we need 10,000 units of this part for a production run next week. If TI has it on the shelf, they win the order instantly. Their competitor has to go make it, and that's a 12 to 20-week lead time.
So in a world where supply chains are still traumatized from the last few years, availability is a feature.
Availability is the best ability. By holding that buffer, TI effectively becomes the central bank of analog chips. They can provide liquidity to the market.
And gain market share in the process. I mean, if you're a procurement manager at Siemens and you can get the part from TI tomorrow or from someone else in 3 months.
You're buying from TI, even if it costs a penny more. And once you design that chip into your product, you are not swapping it out. That socket is theirs for the life of that product.
So the inventory is a market share weapon, provided the demand actually comes back.
Which brings us back to that slowest recovery ever comment. It is slow. China is choppy up 16% in Q4, but dipping for Lunar New Year. Europe is struggling. The headwinds are real.
But the guidance implies we've hit the bottom. The bleeding has stopped. And for shareholders, they've been paid, and paid very well, to wait.
Generously. They
Right.
returned $6.5 billion to owners in the last 12 months, raised the dividend for the 22nd consecutive year.
That consistency is why people own the stock. It's not for, NVIDIA-style gains. It's for the compounding. But I want to close on a provocative thought about that inventory.
Okay.
We know that during this downturn, a lot of TI's competitors cut production. They shut down older factories to save cash. They burned through their inventory.
They zigged while TI zagged.
Exactly. TI kept their fabs running. They built the stockpile. So here's the scenario. 2026 progresses. Interest rates come down. The industrial economy finally snaps back for real. Suddenly, there is a rush for analog chips.
A supply squeeze.
A huge supply squeeze. And in that squeeze, TI is the only player with $4.8 billion of product ready to ship on day one. Their competitors are scrambling to restart cold manufacturing lines, which takes months.
TI could dominate the entire recovery just because they were prepared for it during the winter. That's the capital allocation thesis in a nutshell.
And it would turn the slowest recovery in history into a massive market share consolidation event for them. It's a high-stakes poker game, and TI is holding a lot of chips. Literally.
It certainly puts that inventory number in a different light. It's not dead weight. It's potential kinetic energy just waiting for a spark.
We'll have to watch the next couple of quarters to see if that spark actually lights. But for now, the bellwether is telling us the storm has passed.
And the rebuilding is beginning.
As always, you should check the show notes. We've linked to the full earnings transcript and the capital presentation, so you can check all the data for yourself.
It's worth digging into the details on the new Sherman fab. The scale is just impressive.
Thanks for diving deep with us today. We'll catch you on the next one.